Hi, this is Daniel. You're watching Unrivaled Investing, a no-hype, mission-focused channel to try to find you exceptional companies and unrivaled investments. I previously did a video on Bill Ackman's SPAC, PSTH, which at the time was rumored to be acquiring a stake in UMG, Universal Music Group. Subsequent to that video, additional details came out where Bill Ackman confirmed indeed they are in talks to buy a stake in Universal Music Group, about 10% of the company, for about 35 billion euros. But it's a lot more complex than that. And honestly, as I look at this deal, I'm just not super impressed by it. The previous video largely was on point in terms of UMG, the valuation. I'll go through a couple of those things, quick recap in this video. But by and large, the types of companies I'm looking for, I like better asymmetry, better risk reward, where I'm looking at potentially hundreds or even thousands of % upside over time versus what I think you're getting potentially with PSTH stock now. So I'm not super compelled by it, but let's go through it. And if you have additional thoughts in terms of something that I'm missing, maybe the upside with UMG, I'd definitely love to hear it in a comment below. So let's get into this. So first, one should understand this isn't my first video on it. I did a quick video before it was officially confirmed. At the time, it was a rumor on Bloomberg, but this previous video I did asking whether or not it was a good deal to be merging with UMG, I did talk about valuation and the company. I believe this video was largely on point, but there was a lot of additional complexity announced since then, and we'll talk about that in this video. And as a quick recap, they're buying a 10% stake in Universal Music Group for around 35 billion euros. Now keep in mind, this is still in discussion, so this could still very much change. This is not set in stone yet, and I would expect if this deal does become finalized, they'll do a full fancy presentation that makes the case on why, the Bill Ackman 1,000-page presentation on why this is such a compelling opportunity. And so, just once again, this is a recap. The valuation, I did update the terms here a little bit just to sort of say, hey, what does Bill Ackman potentially see that could justify a higher valuation? What would it take? What would I have to see in sort of the high side to deliver a very attractive return? And so how do you get to a 20%, let's say, annualized return? And on the high side, you would need, let's say, 35% optimized margins. And this compares to around 20% today, so nearly doubling their current operating profits. Then their growth rate would need to dramatically increase from, let's say, from a low teens over the last few years. Year to date, 2021, it was closer to low single digits. And then you'd need to get a full valuation multiple 5 years out just to get sort of an attractive valuation. So I'm sort of penciling out in this high scenario, you're probably getting 100-150% return over 5 years. What should these variables do you think I'm potentially being too conservative on that makes you think this deal is worth this value, is worth this $35 billion, where you think, yes, UMG could definitely be worth a lot more? Now keep in mind, this is a framework. If of course the underlying value and ultimate stock price for UMG could go significantly higher or lower, but as I look at this, I think that this strikes me as expensive and requires very full assumptions to sort of justify getting that upside scenario. And there's a good chance that I think Bill Ackman recognizes that there's a real chance that your returns aren't nearly as good as this. And so, but look, maybe they will deliver it. Maybe they will achieve expanding their margins significantly, and accelerating their growth, because they do have some really prime relationships. For example, maybe it seems one generation after another still listens to the Beatles, and maybe you just collect a database of artists where you get effectively pricing power over time. It's like owning this premium rights that give you steady pricing power year after year, raising the prices. But then I wonder, do you truly have that pricing power? Because aren't your costs also probably going to be going up in lockstep, where you're compensating the artists in a similar fashion? We'll see how that sort of plays out. By the way, if you're enjoying this video, I'm planning on making maybe another video on Spotify, just so that we can fully address the different angles of the music industry. So make a point of subscribing to this channel if you want to see that follow-up video analysis. And so looking at this, it's interesting to see that Tencent, the major Chinese conglomerate, bought 10% of Vivendi's Universal Music Group at a $30 billion value, 30 billion euro valuation at the end of last year. And so I'm looking at this and I'm thinking to myself, well, wait a second, this is not that special of a deal. Here it is. The company's growth rate hasn't gone up by, 15, 20%. The company hasn't grown by that much. And so here it is. Ackman's actually paying more than what looks like Tencent was buying at the end of last year at this 30 billion euro valuation. And so, but this is where the complexity starts setting in, because this is not really a traditional SPAC. Traditional SPAC, you got these warrants, you got the SPAC. The SPAC effectively de-SPACs and brings a private company public, and that's not what's going on here. This company, UMG, Universal Music Group, they're going public regardless of Bill Ackman. It makes me wonder, this sort of fits this underlying theme of like, it almost seems like too much money trying to chase after a deal. That's sort of the theme that's playing around in my head as I'm looking at this, because UMG would have been going public regardless. They don't need the SPAC. UMG will complete its previously announced listing on Euronext Amsterdam in the third quarter of 2021. So I'm thinking, well, wait a second, why do I really need Bill Ackman's SPAC here to buy it at a premium when here it is, they're going to be coming public in a few months potentially? And so you're really banking on the idea that, hey, maybe UMG stock will spike in an IPO. There will be such, people will be salivating so much for this asset that here it is, Bill Ackman will have gotten a sweet deal. But the reality is it's already at a, markup from what Tencent was paying just a few months ago. And then once the listing is complete, if UMG officially IPOs, at that point, PSTH stock, or this SPAC, will distribute the UMG shares that they acquired. So this Universal Music Group stock that they acquire, it's private, they're going to distribute it to their shareholders only after UMG is public. So this is by no means a traditional SPAC, and it does raise the risk of like, well, wait a second, what if there's no IPO? What if something happens in the next few months? I mean, look, the capital markets, they're subject to change. What if Federal Reserve reverses course in the next few months and says, we got to tighten our balance sheet? That would be, I don't know if the window for IPOs would still be open. Would you be stuck holding private stock? I mean, what happens in that scenario? So anyway, I don't like this structure where it's, hey, part of it's just like, hey, you're going to be getting stock that you otherwise you could buy on your own volition, maybe at a lower, maybe at a higher valuation in the months ahead. And then not only that, but as part of this SPAC, they're not actually saying, hey, we're going to use the full proceeds of PSTH stock to acquire the UMG shares. We're still going to have about around $1.5 billion in cash. So there's going to be this RemainCo SPAC, so a vehicle that they can use to buy another company, as if they didn't already have enough problems finding a deal to acquire. It's sort of like, hey, well now you're banking on us finding another company to acquire. And by the way, there's going to be this asset, this transferable 5-year right per share, or a SPAR, which we'll talk about in a second. That's some additional potential value. It's going to be really one of these funky securities that, in all honesty, it does strike me as some sort of special situation investing that could create a lot of value if this were to get sold off significantly and trade at pennies on the dollar. So, I mean, I would be interested in seeing that. What's the value for that? But overall, most of the asset at this point is buying the UMG, equity, buying that 10% stake, and I'm not, super compelled by it based on the valuation I already walked through. And so what are these other two components? It's the RemainCo SPAC. So after funding the UMG purchase and related transaction expenses, the RemainCo will have $1.5 billion in cash and marketable securities. And I wonder, looking at this, like, why? And this SPAC is going to look for another deal to acquire another company and bring it public. And so I'm looking at this, I'm wondering, like, why aren't they putting all their capital? Why is this such a non-traditional deal? And I'm thinking, always ask why with investments. You always want to ask the basic, who, what, when, where, why, trying to understand the setup here. So I'm thinking either Bill Ackman didn't want to put all his capital into this deal because he's seeing the same thing I'm penciling out with his valuation, which is that over his career, he's definitely come across better risk rewards. he's definitely come across things where it's like, oh man, this is a no-brainer with 200, 300% upside and minimal downside. He's seen things like that. So I bet he's penciling out, oh yeah, all these stars have to align to get a much better, to get a satisfactory return, but by no means is this a grand slam. That's what I suspect he's thinking, and that's the reason why this isn't going like full on in to UMG. Because why not else buy more? Because then it raised the question of like, well, either he didn't want to put all of his capital into it, or Vivendi, which currently owns the majority stake in Universal Music Group, wanted to get more upside potential with an IPO. But that, honestly, I'm a little skeptical on that thesis, and I think I lean more towards the first point, which is that, wait a second, they were just selling a stake for 30 billion euros, a few months ago. And so here it is, they're getting several billion more euros with Bill Ackman at a premium and at a better valuation than they previously were. So I really don't, I would be surprised if it's the second case of Vivendi saying, you know what, let's just hold off until the IPO and get more money for it. That's at least my take on it. If you have a different point, I'd love to hear it, or if you think I'm missing an angle, leave it in the comments below. And then the other third, this 3-for-1 deal that you're looking at, is you're going to get this SPAC. So hey, Sparky, so Special Purpose Acquisition Rights Company. So that's what SPAC stands for. And instead, SPAC intends to issue rights to acquire common stock in SPAC for $20 per share to PSTH shareholders, which can only be exercised after SPAC enters into a definitive agreement for its initial business combination. So they're trying to create a better vehicle. They think this is a better vehicle than SPACs. I have mixed feelings on this. And they're saying the SPAC structure has been designed to allow SPAR holders to avoid incurring the opportunity cost of capital of a typical SPAC. So i.e. you're buying shares of a SPAC and you're just sort of sitting and it's trading around NAV and you're trying to figure out what to do. And here it is, you might not get a deal done. You might just sort of have dead money for a few months. He's saying, hey, you don't need to do that. What if you just have a note that effectively gives you the right to exercise, to buy into it at NAV once the deal has been signed? Isn't that compelling? Like, wouldn't that be a good deal? Now, the SPAC sponsor will also benefit by not having any time pressure associated with the typical 2-year SPAC commitment period. So once again, Bill Ackman's giving himself a nice little out here saying, hey, if we actually don't find a great deal in the next 2 years, that's okay, because this SPAC, it actually has a 5-year time frame. And also, the way this is structured is no vote will be required from other shareholders to consummate a transaction. So these SPAC units or SPAC, warrants or rights, it's effectively, you're making a bet that Bill Ackman will find something in the future and that you'll want to buy into it at $20 a share. And honestly, I'm conflicted on the appeal of this versus a SPAC because, as Bill Ackman knows himself, this is the difference between a promise of capital versus permanent capital. This is sort of saying, hey, in a moment where we want to exercise a deal, we're going to hopefully have these shareholders that are willing to exercise these rights, effectively transfer money to us so that way we can exercise this deal. And that isn't, in my opinion, as good as having permanent capital. When you really need it, you don't want to have to go around the world and say, hey, are you going to exercise your rights? And Bill Ackman's very aware of that, and so he's trying to structure this in an advantageous way for him. But either way, like if and when there's a point of panic or really, that there's a break in the market and you're able to get things at a bargain, I don't think you want to have this type of structure. I think, honestly, having that cash sitting there in a SPAC is an advantage in that setup. And so what are my summary thoughts, as I'm looking at all this? And honestly, I'm looking at this and I'm thinking there are just simply better deals out there. I wasn't super impressed with it. And keep in mind the valuation I showed earlier, that 35 billion euro valuation. When you're thinking about this, you really should be thinking of it as a premium to that, because currently PSTH stock still does trade at a premium to NAV. And when I look at this, they're just simpler plays that are more compelling, that have better growth profiles, better risk reward. And ultimately, if Bill Ackman is right, and a lot depends on him being right on this sort of that upside scenario in terms of margins nearly doubling, growth rate dramatically accelerating from what they're currently doing, If that is the case, I suspect you'll have years to get in. You'll have years to watch Universal Music Group execute and deliver. And the perfect example is you look at the major tech companies today, they're delivering 20, 30, 40% plus growth, and they trade at very reasonable valuations, some could argue. And you could have watched this play out over years. Whereas with Universal Music Group, you sort of have to, at this point, bank on a transformation that hasn't really happened yet. So why not just wait a quarter or two? They might be public at that point, in which case you can just buy it directly and you don't need Bill Ackman. There's also this possibility that the deal doesn't close, as it's still in discussions. There's a lot that can happen between now and then. There are also, in my opinion, SPACs that just have better risk reward. For example, I mean, you can find SPACs out there where they've announced a deal, they trade below NAV, and they have better growth prospects and potentially better risk reward than Universal Music Group. For those, if this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. And, part of my shtick here is that I call out Unrivaled Investing, and you go to Unrivaled Investing, click on Journey, and you can follow my personal investment journey. First week of the month, I call out my full portfolio. And then also once during the month, I also give a call out a company that I think is a potential multi-bagger, or a type of stock that I think has potentially hundreds or even thousands of % upside over time. And I'm generally looking for asymmetric bets, where it's much better risk reward or dramatic upside versus the downside. And, I'm looking at this and I just don't see this UMG currently as having that really asymmetric risk reward. And, I'll call out to Journey subscribers a SPAC that I think has, way exponentially better growth prospects in trades below NAV. And so that's part of the appeal that I'm trying to do with Unrivaled Investing. Click on Journey. And also, when I think about, Bill Ackman, and I think there's probably a touch of pride here, maybe some hubris about, hey, I have the largest SPAC, or I raised these billions upon billions of dollars to find a deal. And honestly, I'm thinking of Warren Buffett and how he's talked about for decades, effectively using his elephant gun. He's look, of course, he doesn't want to kill an elephant. Not to be too literal, but he's looking for these mega deals. He's looking for these big companies, these 30, 40, $50 billion companies that he could get at a good valuation. And it's exactly the folks like Bill Ackman that I think are paying up and banking on margin expansion, banking on a full valuation that I think more conservative, more prudent investors just simply wouldn't be willing to do, like Warren Buffett. And I think this deal does sort of reflect that, yeah, Bill Ackman, yes, this approach of doing this outsized SPAC, this is very hard to find a deal that sort of fits everything, including the valuation criteria. And as such, you're going to have to do this really wonky structure that makes it way more complex than it needs to be. And at the end of the day, you don't have to be invested in those elephants. As Warren Buffett knows, it's hard to find those deals because the risk reward generally isn't as compelling. And it's part of that, I think, regular investors, smaller investors, retail investors, this is your advantage. This is where you can lean in, where you can find, let's say, smaller companies where the risk reward is way more asymmetric. And for more about that, go to unrivaledinvesting.com, click on Journey, and also make a point of subscribing to this channel. I'm regularly going over companies that, might be under $10 billion where the valuation is way more asymmetric. So if you enjoyed this video, please make a point of subscribing. If you're already a subscriber, I do appreciate that thumbs up, and thanks so much for watching.